people that I talk to that have that type of experience, they are very motivated in order to do planning so they don't have to put their family through what they've been through, based on that experience.
So my understanding is that you design a plan for them.
Well, that's really the key, because so many times people think that a long-term care plan or extended care plan is like one package, that you come in and you sit down and then you have to determine, can I afford that or not afford it or whatever. And that's not the way it works at all. We basically go through much the same as you would go through with your financial planner if you were trying to set up an investment program, doing a risk tolerance survey to help that planner design a plan for you. I do essentially the same thing, going through with a lot of questions so that I am actually helping you design the plan that you want based on your goals, objectives, and desires and everything. And then once we get that plan designed, then we look at the cost aspect, and if that doesn't fit with your budget, then we know where we can massage and change and mold and everything to bring it in line. So the bottom line is, when we finish with one of these planning sessions, the plan you end up with is your plan that you have designed, and you have determined what is a reasonable amount of money to set aside for that plan.
So what are the basic solutions? We've talked about Medicare, Medicaid, we've talked about self-insuring, we've talked about using family. What are the best ways to offset some of these costs?
Well, from the most cost-effective way to handle the the future costs of this, is to use some type of an insurance solution, because basically you're using discounted dollars, and in many cases these plans have some tax advantage to them. So from a financial standpoint, it's the most cost-effective way to do it. Some people, based on the design and the type of plan they want, would be best served with what we would call a traditional long-term care policy, one that is designed specifically to handle long-term care, extended care issues with all the benefits and features and everything in it. Some people, for different reasons, and this is what we find out when we're doing the design, like the type of plan that basically starts with either a life insurance or an annuity chassis, and then adds a long-term care rider to that. And there's pluses and minuses on that type of solution. So I know I've sat down with people that said that they've looked at these types of things before, and in the conversation what we determined is that whoever they sat down with basically had a preconceived idea and what I call a plan in their hip pocket when they came to sit down with the person, and they were trying to then market the advantages and benefits of that particular plan. But it wasn't really something that was designed by the individual. It was more what the representative was bringing in.
We hear a lot about long-term costs increasing. We hear a lot about insurance companies suffering huge losses, and we hear about insurance companies actually dropping the long-term care products. Perhaps you talk about that.
Okay. When long-term care was first designed back in and first came to the public back in the mid-70s, there was no data or statistics based on the product. It was new, and it was trying to look into a fog bank as to try and determine how do we price this product. And one of the things that, as an example, when actuaries price a product, and they were basically using as the model life insurance because they had so much data and statistics to work on. One of the things they use in the pricing is what they call a lapse ratio, which means that, let's say, out of 1,000 policies that are sold, there's going to be some percentage of people that, for whatever reason, are going to drop that policy, lapse the policy, before it pays off as a claim. So from an actuarial standpoint, if they project that percentage into their calculation, they can reduce their premium. So what they did was they used the life insurance lapse ratio of about 6 to 7%, and they used that as a discount. So that was one thing. The other thing was they had no claims experience, so they really didn't know what the claims utilization rate would be looking into the future. Well, what they found out over time is that it's a lot more than what they calculated. And also, and we're all suffering this, for the last several years, we have been in a very, very low interest environment. Insurance companies are able to pay their claims based on two things: the premium inflow on the product they sell and the rate of return that they get on their reserves that they set aside. So when they started with this, they were using 5–6% on rate of return. It was quite normal. We were all getting a lot more interest at that time. But when we went into this low interest environment and then stayed there, they've got projections, and their product was priced based on these projections. And they're not getting that. They're getting like we are, about 1% or so.
So do you anticipate costs rising on a long-term care policy? Do you see the premiums rising significantly?
On older products, we're already seeing that. They have to raise the premiums so they're still a viable solution and they can pay the claims. Now, policies that are written today, yes, the premium is higher than what they were, say,